OECD project to address BEPS, or base erosion and profit shifting, continues to change the international tax landscape for large multinational corporate enterprises, or M&Es. There are 15 actions currently being rolled out by world governments in an effort to address BEPS. And today we're placing a spotlight on BEPS action to address the tax challenges arising from digitalization. There are two pillars, and today we're going to focus on Pillar 2, which refers to the objective of implementing a global minimum tax of 15%. The rollout of Pillar 2 has already started in several countries, and in South Africa, the National Treasury has indicated that the country will follow international best practices, which means that SA-based multinationals will be impacted by Pillar 2 imminently and will therefore need to be ready. Now, joining me to unpack this really interesting discussion is Professor Osman Mulaji, PwC International Tax and Transfer Pricing Partner. Osman, thank you so much for sitting down with us today. I think it's going to be a rather interesting topic to delve further into. So let's get into it. So from a conceptual or an underlying rationale perspective, right, can you unpack for us how a global minimum tax addresses the digitalization of the global economy and the resultant tax challenges faced by various governments around the globe?
Thanks, Nancy. So I think it's probably important to understand the context of the BEPS project as a whole. And perhaps the biggest impact of the other actions that we're not talking about today of the BEPS project is that they focus on real substance. In other words, making sure that the right profits are taxed in the right countries, but based primarily on the real business that you're doing in substance. And I keep using the word in substance. So, but what that means is, if you understand digitalization, one of the big things that digitalization continues to expand is mobility. So mobility of functions, mobility of people, mobility of intellectual property means that it's easier to really and defensively do some things from anywhere in the world. So what that means is that, yes, tax will continue to be paid in the right countries, but it's perfectly defensible to be doing that from a low tax jurisdiction. So the concern here is not that we're going to try and block mobility. That is not what this action is about, or Pillar 2 is not about blocking mobility. It's about saying wherever you move, we want to make sure that you are paying an appropriate level of tax where you are.
Perfectly understood. So is it then correct to assume that Pillar 2 is really only relevant for groups that operate in, as you put it, low tax jurisdictions? And if you could just expand on what you mean by low tax jurisdiction.
So again, for multinational corporates, the concept of low tax jurisdictions will be well understood. And it generally refers to countries where there's a really low rate of corporate tax. I mean, the headline corporate tax rate is like 5%, or they have no such thing as corporate income tax. So that's really what that refers to. But to your point, not necessarily, and what I mean by that is that it doesn't necessarily mean that if you don't have any operations in any low tax jurisdictions, that Pillar 2 will not apply to you or you won't be caught. Yes, it is correct to say that if you do have operations in low tax jurisdictions, then you do need to think about Pillar 2, and it is highly likely to impact you. But even if you have operations in traditionally high tax jurisdictions, you could be impacted by Pillar 2 as well. Because Pillar 2, the big deal in Pillar 2 is not the headline corporate income tax rate in the particular country. We focus on the concept of effective tax rate. So what you will see is that in many countries, even though they have really high tax rates, you still might end up with an effective tax rate of less than 15%. So for example, I take many of our countries here in Africa where we are notorious for high tax rates, but at the same time, we give incentives like tax holidays, etc., to attract investment. What that means is that as a result, you end up paying an effective tax rate of less than 15% in that particular country. So it'll apply to those scenarios as well.
All right then. What do you see perhaps as the major challenges facing these multinational groups in coming to grips with Pillar 2?
So I think complexity, but again, when you speak to most tax practitioners, our default position, and this is definitely the case with Pillar 2, is to look at it under two headings. The one is the heading of just the complexity of computing the tax liability. How much are we going to end up paying extra? And also the question of reporting and compliance and administration. And under both of those headings, we have a big demand on resources and complexity for multinationals. So taking the question of compliance and complexity as an example, the big question there will be around access to data, technology and systems, etc. And on the question of the computation, the rules have become so complicated and so complex that I think we will struggle on both of those fronts.
Okay. Now you mentioned technology, and I think data and technology are these recurring themes, not only in our broader business operating environment today, right? But largely in the tax world as well. So what does that mean then in the context of Pillar 2?
So in the context of, and the reason I refer to technology is really about access to data. So not only in relation to, building your computation, actually working out what the tax liability is, but also in relation to reporting. So, and when we talk about access to data, it's the fact that a lot of the items of information that you will now be required both for your tax calculation and to report are not available from the traditional sources. So some items of information will be available from, relatively easily accessible, like your published financial statements. But then others will be, not that easy to get to. So you can imagine building a report that starts out pulling out stuff from your financial statements and then having to go into internal in-country systems and trial balances to try and get information from there, maybe in-country tax computations, manual adjustments, etc. And just consider that this will be required for each of the territories where you might be at risk. I think where we are at present is we've modeled that there are around 250 data points, 250 elements of data per country that will need to be modeled and extracted in order to build these reports.
Wow. Okay. Now, everyone always complains that tax calculations are synonymous with complexity. So in the context of Pillar 2, should calculations be seen as perhaps another work stream to be added into the tax function?
Yeah, Haryanti, actually, I do think so, because I think we can see the levels of complexity in the calculation element. I mean, part of the complexity is that you have several different items acting independently and interrelated. I try to simplify it in my own mind to look at it under two headings. But again, everything's interrelated. So the one heading is the fact that there are at least 3 levels of additional taxation. So a lot of people think of Pillar 2 as having, one additional payment of tax, but we are talking about 3 separate taxes that could be imposed at various levels. So it's not only at the level of the head office where your operating entities are in other countries. We're talking about rules, 3 sets of rules for 3 separate sets of taxes that need to be understood simultaneously. And now you have to worry about, ordering, what comes first, what comes second, and am I going to be double taxed or maybe multiple level of tax? How do you coordinate all of those? And that's just because there are three separate taxes that need to be dealt with. And then the second heading that I like to just make sense of is what we refer to as divergences. And when we say divergences, we just simply mean that the different rules will be applied in different places. So for example, the Pillar 2 rules, and we're talking about 3 separate taxes here, will be adopted and become effective in different countries at different dates. So you need to monitor when they come into effect in which country. And if this comes into effect in country 1 today, you understand that. But then when it comes into effect in one of the other countries that you operate in, then not only do you have to worry about that, you also have to worry about what impact it has on country, the first country. So you have different things coming to effect at different times. You also have different interpretations. We're talking about, sovereign states here. So each one has a different interpretation of potentially the same discussion. And then we can have, I can go on, as you would have heard, we talk about complexities within your specific group. So you have things like intergroup transactions between the entities in the same group, or you talk about restructures where things get moved around within the organization. So I think in summary, this has already turned out to be quite a significant level of complexity that's being added.
Evidently so. But given an expert like yourself, obviously in the space, who is in the market to help multinationals navigate this complexity, what would your recommended action points be for multinational groups who might be caught by Pillar 2?
So my primary recommendation is going to be start early. Start early with an impact assessment. And my message also specifically to South African-based multinationals is that even though we are not convinced that Pillar 2 will be implemented in SA in 2024, maybe it'll be 2025. We're not entirely sure when it'll be applicable, but that doesn't change the fact that Pillar 2 will be implemented in other countries. So, for example, you might be a SA-based multinational and you have an operation in the Netherlands. Netherlands is starting from 2024, so it will still impact you. So the question of starting with an impact assessment early is critical. That's probably my primary recommendation, because what that means is that it gets you into the game. It means you need to understand, go into your own system and actually discover for yourself what is easy to find, what's harder to find, what needs further work. It also means you are able to ask the questions, what should I be monitoring? Because this is such a moving target, so many things changing on the global scale relatively quickly. So you need to monitor that as well. And then also importantly, understanding the impact on your own effective tax rate. Are you going to end up paying a lot more tax than you are accustomed to?
Well, certainly important things to consider. Is there anything else you would like to add?
Yeah, I suppose maybe just in closing, I know the phrase tip of the iceberg is overused, but I am a little bit concerned that just the kind of media discussion about it, so even the OECD's own stated objective of saying we're going to try and keep this simple, I think has led a lot of us to kind of to forget, or maybe not appreciate the level of complexity of what lies before us. So I don't like to end up with a negative conclusion, but I am concerned that there will be some significant adverse impact if we don't open our eyes early.
Thank you so much, Osman, for sitting down and sharing these really valuable insights. And thank you to all of you who have joined us for yet another episode on PwC's Boardroom Forum Live.